This is the story of how humans have fallen for the same economic illusions for 800 years. Carmen Reinhart and Kenneth Rogoff, economists who studied 66 countries across 5 continents, found something disturbing in their data. Financial crises exhibit remarkable similarities throughout history, despite every generation believing their circumstances are fundamentally different. Dutch tulip bulbs sold for the price of houses in 1637, and today, AI stocks command 35% of S&P 500 market capitalization, but the psychological drivers remain unchanged while only the vehicles evolve. And here's what makes this pattern so dangerous. Ignorance doesn't doom investors, confidence does. The moments when everything feels safest are historically when the greatest risks accumulate. Over the next 20 minutes, we're walking through 8 centuries of financial history to show you exactly how the same psychological traps keep catching new generations. More importantly, you'll learn how to recognize the patterns before they become personal disasters. Let's start with the timeline, because you need to see just how consistent this pattern really is. 1637 in the Netherlands saw tulip bulbs become so valuable that a single Semper Augustus bulb sold for 5,000 florins, which was the price of a fine house in Amsterdam. The Switzer variety increased 12-fold in January alone, climbing from 60 florins to 1,800, and people were trading contracts for bulbs that didn't even exist yet in taverns rather than official exchanges. Contracts changed hands 5 times or more without a single actual bulb being delivered. February 3rd through 5th brought the collapse. Within days, those tulip bulbs sold for 1 to 5% of their peak value, which meant losses exceeding 95%, essentially overnight. Fast forward to 1720 and the South Sea bubble. The company's stock went from £128 in January to £1,000 in August, and even Isaac Newton got caught up in it, reportedly losing £20,000, which equals about 40 million today. He supposedly said afterward, "I can calculate the movement of the stars, but not the madness of men." Here's the thing about the South Sea Company. It had almost no actual South American trade, was lending money to investors so they could buy its own shares, and was paying 100% interest with no underlying profits. Every warning sign was there, and yet the share price went to £1,000 before crashing to 100 to 24 by December, an 88% decline. 1840s brought railway mania in Britain. Railway share prices doubled between 1843 and 1845. Railways went from 23% of the stock market value to 71%, and 9,500 miles of new routes were authorized, though only 2/3 were ever built. Contemporary observers wrote, "The contagion passed to all, and from the clerk to the capitalist, the fever reigned uncontrollable and uncontrolled." 1907 delivered the Knickerbocker crisis. Cool money interest rates, which are the rates for short-term loans, jumped from 9.5% to 70%, then to 100% annualized in a matter of days. Industrial output fell 17%, real GNP fell 12%, and only the Great Depression would prove worse. It took JP Morgan personally summoning financiers to his library to organize a bailout. 1929 arrived with Irving Fisher, one of the most respected economists of his time, declaring on October 15th that stock prices have reached what looks like a permanently high plateau. The New York Times published this quote on October 16th, 9 days before Black Thursday hit. By October 29th, Black Tuesday, the market had begun a collapse that would ultimately see the Dow fall from 381 to 41, an 89% decline. 25 years passed before recovery came, and Fisher himself lost his entire $10 million fortune following his own advice. 1989 brought Japan's asset bubble to its peak. The Nikkei hit 38,957. Price-earnings ratios reached 80 times earnings compared to historical norms of 15 to 20, and by 1992, the market had fallen 63%. The ultimate low came in 2009 at about 7,600, which meant an 80% decline from the peak, and it took 34 years to recover. 2000 marked the dot-com bubble peak. The Nasdaq peaked at 5048 on March 10th after gaining 572% from January 1995 to that peak. Then it fell 78% to 1114 by October 2002. Over $5 trillion in market value simply vanished. The average internet company lost 88% of its value, and only 14% of tech IPO firms were even profitable at the peak. 2008 brought the housing bubble and financial crisis. Lehman Brothers, carrying $639 billion in assets, filed the largest bankruptcy in US history. The Dow fell 53% from its peak, 8.8 million jobs were lost, and over $10 trillion in global wealth was destroyed. 63% of American households lost wealth. Now here's what should terrify you. Economists have calculated that major banking crises occur on average every 11 years, currency crises every 15 years, and the gaps create just enough distance for each new generation to think their circumstances are unique, to think the old rules don't apply, to believe, as Reinhardt and Rogoff put it, that crises do not happen to us, here and now. So why does this keep happening? If the pattern is so obvious, why do smart people like Isaac Newton, Irving Fisher, and millions of ordinary investors keep falling for it? The answer lives in your brain, which hasn't evolved as fast as financial systems have. Loss aversion comes first. Daniel Kahneman and Amos Tversky won a Nobel Prize for discovering that the pain of losing is psychologically about twice as powerful as the pleasure of gaining, and a 2020 study across 19 countries achieved 90% replication of their original findings. This is hardwired. Here's how it shows up in markets. You hold losing stocks too long because selling means admitting the loss. You sell winners too early because you want to lock in the gain before it disappears. And Brad Barber and Terence Odian studied actual trading accounts to find that the stocks individual investors buy subsequently underperform the ones they sell by about 3 percentage points annually. Your own psychology costs you 3% per year. Then there's herd behavior. Studies published in the American Economic Review and the Quarterly Journal of Economics found that only 5% of informed investors can influence the decisions of the remaining 95%, just 5%, and that's all it takes to move a market. Once the herd starts moving, individual rational actors have incentive to follow even if they suspect it's wrong, because being wrong alone is more dangerous to your career than being wrong with everyone else. Overconfidence bias comes next. Barber and Odian found that men trade nearly 1.5 times more actively than women, which reduced their net returns due to transaction costs, and active traders spent on average 3.9% of their annual income on trading costs. Think about that. People are so confident in their ability to time the market that they'll pay almost 4% of their income for the privilege of underperforming. Recency bias shows up in the Dalbar study from 2003 to 2022, which found that the average equity fund investor earned 6.81% while the S&P 500 returned 9.65%. That's almost a 3% annual gap, largely due to poor timing because people buy after things have gone up, assuming recent returns will continue, and they sell after things have gone down because recent losses feel like they'll persist forever. Confirmation bias appeared in a University of Texas study of 600 participants on online stock trading boards, which found that 85% were disposed to accepting confirming opinions. 70% of those with strong buy opinions clicked only on confirming messages, which means you don't seek truth, you seek validation. FOMO, fear of missing out, drives investors to catastrophic decisions. Stanford research found that what investors fear the most is not the risk of a loss per se, but the risk that they may do poorly relative to their peers. GameStop in January 2021 went from $17 to $483, then crashed to approximately $40, and how many people bought at $400 because they couldn't stand watching others make money? Robert Shiller, who won a Nobel Prize for his work on market psychology, put it this way: irrational exuberance is the psychological basis of a speculative bubble, and news of price increases spurs investor enthusiasm, which spreads by psychological contagion from person to person, like a virus. You think you're immune because you're reading this, because you know about these biases, but here's the thing. Isaac Newton knew about gravity. Irving Fisher was one of the most sophisticated economists who ever lived, and knowledge doesn't immunize you. Pattern recognition does. Sir John Templeton, one of the greatest investors in history, said the 4 most dangerous words in investing are, "This time it's different." Those words appear before every single crash. Reinhardt and Rogoff documented this across 8 centuries and wrote that the essence of the "this time is different" syndrome is simple. It is rooted in the firmly held belief that financial crises are things that happen to other people in other countries at other times, and crises do not happen to us, here and now. Let's look at the specific arguments each generation made. 1929 wasn't just Irving Fisher saying stocks would go up. He had a theory he called the New Era. 9 days before Black Thursday, he declared stocks had reached a permanently high plateau, believing fundamental changes in the economy like new technologies, better management practices, and the Federal Reserve System had eliminated the old boom-bust cycle. Sound familiar? 1999 brought the Dallas Federal Reserve publishing its annual report with a section titled The New Paradigm. They wrote that scarcity, the first assumption of the old economy, isn't the dominant feature of the new economy, and increasing returns to scale pervade the new economy. The new economy became the phrase. The internet changed everything. Old valuation metrics didn't apply. Earnings didn't matter because you were buying growth. And the Nasdaq gained 86% in 1999 alone before losing 78% of its value over the next 2.5 years. 2005 through 2007 delivered the housing bubble. The argument here was simple. Housing prices never fall nationally. That was the mantra, and it had been true in the data since the Great Depression, which meant mortgages backed by houses couldn't really be risky. You could lend to anyone because even if they defaulted, the house would be worth more. We all know how that ended. Paul Krugman wrote about Japan's bubble this way. Japan's banks lent more, with less regard for quality of the borrower than anyone else's, and in doing so, they helped inflate the bubble economy to grotesque proportions. But at the time, at the peak in 1989, people believed Japan was simply superior with better management, better work ethic, and a fundamentally different economic model. The Tokyo real estate market alone was valued at more than all real estate in the United States. Price-earnings ratios of 80 times were justified because this was Japan, and this time was different. 34 years passed before the Nikkei recovered. Templeton noted that when people say things are different, they're right only about 20% of the time, just 20%, and you won't know which 20% until after the fact. Now let's talk about how modern financial systems make all of this worse by hiding risk behind complexity. 2008 is the perfect case study. Collateralized debt obligations, or CDOs, worked like this. You take a bunch of subprime mortgages rated BBB or A-, bad loans, bundle them together into tranches, and then rating agencies would rate 70 to 80% of these tranches as AAA, which is the highest possible rating, the same rating as US Treasury bonds. How? By arguing that diversification and structure eliminated risk, so collateral with an average credit quality of B was structured until 70% of liabilities got AAA ratings. From 1983 to 2006, structured finance tranches grew from 29 issued annually to 47,055. The market exploded, and almost no one understood what they were buying. An S&P employee sent an internal email before the collapse. Let's hope we are all wealthy and retired by the time this house of cards falters. They knew. The complexity wasn't eliminating risk, it was obscuring it. By the end of 2008, 91% of CDO securities were downgraded, AAA-rated tranches lost up to 90% of their value, and financial institutions wrote down over $500 billion. Global wealth destruction exceeded $10 trillion, but the warning signs were there years earlier. Long-term capital management in 1998 ran a hedge fund staffed by Nobel Prize winners, literally Myron Scholes and Robert Merton, who had sophisticated mathematical models assuming historical correlations would hold. Their models said certain positions that had diverged would eventually converge, and they could profit from that convergence. Then Russia defaulted in August 1998. Suddenly, positions that were supposed to converge diverged dramatically. The fund's leverage went from 25 to 1 in January to 130 to 1 by September, and they lost $4.6 billion in less than 4 months. 44% in August alone, which required a $3.6 billion bailout coordinated by the New York Federal Reserve to prevent a systemic collapse. Warren Buffett wrote about this in his 2002 Berkshire Hathaway letter. Derivatives are financial weapons of mass destruction, carrying dangers that, while now latent, are potentially lethal. How big is the derivatives market today? According to the Bank for International Settlements, as of June 2023, there are $715 trillion in notional outstanding derivatives, while global GDP is about $100 trillion, which means the derivatives market is 7 times the size of the entire world economy. Notional value isn't the same as actual risk exposure, but here's the question. Do you understand the risk? Do the people managing your pension fund understand it? Or is the complexity doing exactly what it did in 2008, hiding risk until it explodes? The more sophisticated the instrument, the easier it becomes to convince yourself you've eliminated risk when all you've done is make it harder to see. Now let's talk about the other way societies hide from economic reality: printing money and accumulating debt. Weimar Germany is the classic example. After World War I, Germany had massive war debts and reparations payments, and rather than raise taxes, which would have been politically unpopular, they printed money. By November 1923, $1 equaled 4.2 trillion marks. Bread prices tell the story. 1919, 1 mark per loaf. End of 1922, 160 to 200 marks. November 1923, 200 billion marks. People's life savings became worthless. Workers needed wheelbarrows to carry enough cash for daily purchases, and the social and political consequences helped pave the way for extremism. The 1970s brought stagflation, which was the combination of high inflation and high unemployment that wasn't supposed to be possible. 1964 baseline: 1% inflation, 5% unemployment, but by 1974, over 12% inflation, above 7% unemployment. Summer of 1980 delivered inflation near 14.5%. The resolution required Paul Volcker to raise interest rates so aggressively that unemployment hit 11% because they had to accept a deep recession to break inflationary expectations. There's no painless way out once you've inflated. After 2008, the Federal Reserve's balance sheet went from $850 billion pre-crisis, which was 6% of GDP, to $4.5 trillion by October 2014, which was 25% of GDP, a five-fold increase. After COVID, they did it again. The Fed's balance sheet went from $4.2 trillion in February 2020 to $8.9 trillion at its peak in early 2022. More than doubled, and the M2 money supply increased by $6.25 trillion, a 40% growth in 2 years. The consequence: inflation reached 8% in 2022, the highest since 1991. Where are we now? As of December 2025, the US national debt stands at $38.4 trillion. Debt to GDP sits at 99%, projected to hit 122% by 2034. And interest payments alone cost $1.126 trillion in fiscal year 2024, up $251 billion from the previous year. The debt increases at a rate of $6.12 billion per day. Global debt, approximately $323 trillion, which equals 235% of global GDP. Ray Dalio, founder of Bridgewater Associates, called this situation an economic heart attack in July 2025, saying we're spending 40% more than we're taking in. Here's the thing about debt: it doesn't eliminate problems, it just moves them forward in time. And the longer you defer the adjustment, the more painful it becomes when it finally arrives. Ludwig von Mises put it bluntly: there is no means of avoiding the final collapse of a boom brought about by credit expansion. Every society thinks they can manage it, that they can thread the needle, that this time is different, and then reality arrives. Now we get to the most counterintuitive insight in all of financial history. The thing that makes crashes so predictable and yet so impossible to time. Hyman Minsky was an economist who studied financial instability, and his core thesis was 3 words: stability is destabilizing. Think about that. The periods when everything feels safe, when the economy is growing, when investments are paying off, when confidence is high, those are the periods when the greatest risks accumulate. Minsky identified 3 stages of finance. First, hedge finance, where borrowers can pay both principal and interest from their cash flows, which is sustainable, safe, and boring. Second, speculative finance, where borrowers can pay the interest but have to refinance the principal, betting on continued access to credit markets, which works fine as long as conditions remain stable. Third, Ponzi finance, named after Charles Ponzi's famous scheme, where borrowers can pay neither principal nor interest from cash flows and rely entirely on rising asset prices to refinance and stay solvent. Here's Minsky's insight: transitions from hedge to speculative to Ponzi finance happen naturally during prolonged prosperity. As memories of the last crisis fade, lenders relax standards, borrowers become more confident, and risk that seemed unacceptable 5 years ago now seems prudent because look how well it's worked for everyone else. The term Minsky moment was coined by Paul McCulley during the 1998 Russian financial crisis and LTCM collapse, and it describes a sudden collapse of asset values after a long period of growth, sparked by unsustainable debt or speculative pressures. Think about how this played out in 2008. During the housing bubble, lending standards progressively declined from requiring 20% down and full documentation to 10% down, then 0 down, then no documentation with liar loans where stated income wasn't verified, then ninja loans with no income, no job, no assets. Each step seemed reasonable in isolation. Why shouldn't credit-worthy people with irregular income be able to get mortgages? But collectively, the system was transitioning from hedge finance to Ponzi finance. The entire structure relied on housing prices continuing to rise, and the moment they stopped rising, the moment people couldn't refinance, the cascade began. Silicon Valley Bank in March 2023 is another perfect example. 93.9% of their deposits were uninsured, above the FDIC limit. They had invested heavily in long-term bonds, and when interest rates rose, those bonds lost value. When depositors got nervous and started withdrawing, $42 billion left in a single day, and the bank failed. Second largest bank failure in US history, and it happened almost overnight because confidence evaporated. One day, Silicon Valley Bank seemed fine. The next day, everyone was running for the exits. This is why peak confidence is more dangerous than visible collapse. During a collapse, everyone knows there's a problem, prices adjust, and risk becomes obvious. But during the confidence phase, risk is accumulating invisibly. Minsky wrote, "Over periods of prolonged prosperity, the economy transits from financial relations that make for a stable system to financial relations that make for an unstable system." When everyone feels safe, that's when you should be most afraid. So let's talk about right now, because if the pattern holds and 800 years of history suggests it does, we should be able to identify warning signs in the present. Cryptocurrency gave us two spectacular collapses recently. Terra Luna in May 2022 wiped out 40 to 50 billion in market capitalization in about 3 days. Luna went from a peak of $119.18 to effectively zero, a 99.99995% loss, and the founder, Do Kwon, was sentenced to 15 years in December 2025. What was the warning sign? The Anchor Protocol was promising 19.5% yields in an environment where treasury bonds paid maybe 2%. So how exactly was this sustainable? It wasn't, but people wanted to believe because blockchain, because DeFi, because the future, because this time was different. Then FTX in November 2022. $32 billion valuation, 1 million users, Sam Bankman-Fried appearing on magazine covers and testifying before Congress, and there was an $8 to $9 billion gap between liabilities and liquid assets. The bankruptcy trustee who had handled Enron said, "Never in my career have I seen such a complete failure of corporate controls." 2023 gave us the biggest year ever for bank failures by assets, $548.7 billion, with Silicon Valley Bank, First Republic, and Signature all gone. But let's talk about what's happening right now that should concern you. The Magnificent Seven, which includes Apple, Microsoft, Google, Amazon, Meta, Tesla, and Nvidia, comprise approximately 35% of the S&P 500's market capitalization. 5 companies hold 30% of the S&P 500 and 20% of MSCI World, which represents the greatest market concentration in 50 years. People are calling it the AI bubble. Nvidia is up approximately 1,300% since late 2022. But here's the thing. In an August 2025 MIT report, researchers found that despite 30 to 40 billion in enterprise Gen AI investment, 95% of organizations are getting zero return. Is this exactly like the dot-com bubble? Not quite. The price-earnings ratios tell a different story because Nasdaq 100 forward PE at the dot-com peak was around 60 times, while today it's around 26. These companies actually make money, unlike many dot-com firms where only 14% were profitable. But concentration is its own risk. If you own an S&P 500 index fund, 35% of your money is in 7 companies, all in related sectors, all making the same bet on artificial intelligence. Commercial real estate is another flashing warning sign. The national office vacancy rate is 19 to 20.7%. a historic record. Office values are down about 30% from the 2022 peak, and US banks hold $3 trillion in commercial real estate loans. 1.7 trillion of that, which is 30%, is maturing between 2024 and 2026. And Jerome Powell has warned the Senate about impending small bank failures from CRE exposure. Overhanging everything is the debt. 38.4 trillion in US national debt, global debt at 323 trillion, which equals 235% of global GDP. These are record levels, and the costs of servicing this debt are rising as interest rates normalize. Ray Dalio said in April 2025, "Right now, we are at a decision-making point and very close to a recession, and I'm worried about something worse than a recession." Jeremy Grantham said, "We are in the midst of a historic asset bubble, and when it bursts, it will likely lead to an economic downturn worse than 2008. Are they right? Nobody knows. That's not the point. The point is recognizing the pattern. High concentration, record valuations in specific sectors. This time is different arguments about AI being transformative, a paradigm shift where the old rules don't apply, complexity in markets, record debt levels, and most importantly, widespread confidence that things are fine." So what do you do with this information? First, understand what doesn't work. Prediction. Nobody can consistently predict when bubbles will pop, and if they could, they'd be trillionaires. Irving Fisher couldn't predict it, and he was one of the smartest economists of his era. Isaac Newton couldn't predict it, and he understood gravity, and you won't either. But here's what does work. Pattern recognition. When Terra Luna was promising 19.5% yields, you didn't need to predict the exact date of collapse. You just needed to recognize that 19.5% sustainable yields don't exist in a 2% interest rate environment. Pattern recognition. When Silicon Valley Bank had 93.9% of deposits uninsured and was heavily invested in long-term bonds while interest rates were rising, you didn't need to predict the bank run. You needed to recognize that this was the same risk profile that killed banks in the 1980s savings and loan crisis. Pattern recognition. When dot-com stocks were trading at price-earnings ratios of 60 plus and only 14% of companies were profitable, you didn't need to time the exact top. You needed to recognize that no, it's not different this time, earnings do matter, and 60 times sales isn't sustainable. Pattern recognition. Here's what the research shows about sophisticated versus unsophisticated investors. A study of the Terra Luna crash by NBER, Harvard Law, and MIT found that wealthier and more sophisticated investors were the first to run and experience much smaller losses, while poorer and less sophisticated investors not only ran later and had larger losses, but a significant fraction of them attempted to buy into the run, hoping to buy the dip. It's not about being smarter, it's about recognizing patterns. The sophisticated investors had seen this before, maybe not with cryptocurrency specifically, but they recognized the pattern. Unsustainable yields, increasing risk, changing behavior of other smart money. They didn't need to understand blockchain, they understood financial history. The Dalbar study shows the cost of not having this knowledge. Average investors earned almost 3% less per year than the market because of poor timing. Buying high after strong performance and selling low after losses, and over a 20-year period, that 3% annual gap compounds into about 45% of potential returns lost to bad timing. So here are the patterns to watch for. 1. Extreme concentration in a single sector or theme. When everyone is making the same bet, you should be nervous. 2. This time is different arguments becoming mainstream. When you hear that old rules don't apply, that's not innovation, that's denial. 3. Complexity that nobody fully understands but everyone assures you is safe. If you can't explain the risk, you shouldn't take it. 4. Unsustainable yields or returns. If something offers twice the return of everything else for supposedly the same risk, it's not the same risk. 5. Leverage increasing throughout the system. When borrowing is cheap and easy, trouble follows. 6. And most importantly, widespread confidence. When everyone from your taxi driver to CNBC is telling you everything is fine and you're foolish to worry, that's historically when you should worry most. Reinhardt and Rogoff studied 800 years of financial history and concluded that this time is different are perhaps the 4 most costly words in the English language. They found that major banking crises occur on average every 11 years, currency crises every 15, and the specifics change but the pattern doesn't. You can't prevent crashes because you're not in control of the global financial system, but you can recognize when conditions resemble past episodes. You can diversify, you can reduce exposure to over-concentrated sectors, you can avoid chasing performance, and you can keep some dry powder for when opportunities emerge after the inevitable correction. As legendary investor Sir John Templeton noted, when people say things are different, they're right only about 20% of the time, and your job isn't to figure out which 20%. Your job is to recognize the 80% where the old patterns still apply. We started with the observation that humans have fallen for the same economic illusions for 800 years, and we've walked through Dutch tulips and South Sea bubbles and railway mania and 1929 and Japan's lost decades and .com and 2008 and crypto and SVB and everything in between. The vehicles change, the psychology doesn't. Loss aversion, herd behavior, overconfidence, recency bias, confirmation bias, and FOMO aren't bugs in human psychology that can be fixed with education. They're features, they're hardwired, and the financial system exploits them. This time is different has preceded every major collapse in modern history because every generation genuinely believes it. The technology is better, the understanding is deeper, the regulations are smarter, and so the old rules supposedly don't apply, except they always do. Complexity doesn't eliminate risk, it hides it. Whether it's CDOs in 2008 or LTCM's mathematical models in 98 or derivatives at 715 trillion today, sophistication creates the illusion of safety while obscuring danger. Inflation and debt don't solve problems, they defer them. From Weimar Germany to the 1970s to today's 38 trillion in national debt, printing money and borrowing from the future eventually sends the bill, and there is no painless way out. The most dangerous phase isn't collapse, it's confidence. Minsky showed us that stability breeds instability, and prolonged prosperity causes lenders to relax standards and borrowers to increase leverage until the system transitions from sustainable hedge finance to unsustainable Ponzi finance. When everyone feels safe, that's when the greatest risks accumulate. Right now, we have AI stocks commanding 35% of market capitalization, commercial real estate vacancy at historic highs, global debt at 235% of GDP, banks holding trillions in maturing CRE loans, and widespread belief that central banks have everything under control, that AI really is different, and that the old rules about concentration and valuation don't apply anymore. Maybe it is different this time, but 800 years of history suggests that's the 20% bet, not the 80% one. The solution isn't prediction, it's pattern recognition. You won't time the top, but you can recognize when the patterns from 1637 and 1720 and 1929 and 2008 are repeating, and recognition allows preparation. As Reinhardt and Rogoff concluded, the essence of the "this time is different" syndrome is simple. It is rooted in the firmly held belief that financial crises are things that happen to other people in other countries at other times, and crises do not happen to us, here and now. Except they do, they always have, and they always will. Because human psychology evolves far slower than financial systems, because stability is destabilizing, and because this time is never actually different in the ways that matter. Your real wealth isn't protected by being smarter than the market, it's protected by understanding that the market is never as smart as it thinks it is, especially when everyone agrees that everything is fine. The pattern is 800 years old and it's happening again, right now. The only question is whether you'll recognize it in time.